If you're looking at the daily chart and seeing a downtrend, you're already late. What most traders completely missed is that last week's vicious drop was a forced liquidation engineered to shake out weak hands. And right now the market is quietly rebuilding a structure that could launch the next great bull run. The trap is set. The question is whether you walk into it or ride it. There is one danger zone and one hidden opportunity today, and I'll show you both. The level is 45.86. Write it down. If we close a 4H candle above that number, every bearish thesis falls apart. Stay until the end because I'm giving out 3 exact entry and exit levels you can execute right now. Conservative, standard, and high-risk aggression. We are mapping the entire battlefield. This is your instant market verdict. We are in a counter-trend rally fading into a decision point. The session bias is cautiously bullish on the very short term, but we respect the daily and weekly bearish current until 45.86 is breached and held. That means we are range-bound between 45.41 and 45.86, with an upside breakout bias only if the dollar continues to bleed and real yields compress further. The invalidation level that proves me wrong is a clean 1H close below 45.41. If that support cracks, the forced liquidation narrative dies and the daily sell trend reasserts, dragging us toward 45.15 and potentially much lower. Write this number down. 45.41. If we break below 4,541 today, the whole bullish structure shifts to a distribution pattern, and we flip to short side priority. Got it? Put that number in the comments right now. It's your line in the sand, now let's go deep. I'm narrating the chart top-down because that's how institutions think. On the monthly time frame, gold is still a screaming strong buy. The massive trend from the October lows is untouched. The 200-month moving average is way down at levels we don't even care about right now. But here's the contradiction. The weekly chart is on a sell signal. The price is below the weekly MA20 and MA50, and the MACD on the weekly is rolling over, telling us the multi-month momentum is negative. That's the puzzle. The daily chart is also in a sell condition. Price is trading at 45.69, sitting beneath the daily MA20 at 46.01, beneath the MA50 at 46.74, and barely holding above the short-term MA5 at 45.50. The MA10 is at 4,563, just below current price, so we are actually hugging that 10-period average right now. The daily MACD is still in negative territory, but the histogram bars are shrinking, hinting at a potential bullish cross in the coming sessions if price can muscle through 45.86 and then 46.01. Now drop to the 4-hour. This is where the trap gets interesting. The 4H trend is officially a strong buy, despite the higher time frame sell signals. The 4H MA20 has started to curl up, and price is above it. The MACD on the 4H is showing a subtle positive divergence, lower lows in price during that liquidation flush, but higher lows in momentum. That's the hidden energy. Then down to the 60-minute. Strong buy across the board. The 1H MA20, MA60, and even the MA200 on the 60-minute are all sloping up. The 200-period moving average on the hourly is all the way down at 44.10, almost irrelevant, but the fact that price is above the cluster of short-term Mars says the immediate pressure is upward. Here's the most crucial structural fact. The 200-day simple moving average sits at 4,378, miles below. That's a bullish anchor on the daily horizon. Meanwhile, the daily resistance at 45.86 is the neckline of a potential inverse head and shoulders pattern forming on the 4H. That's why I call it the pivot of the week. A breakout above 4,586 opens a fast lane to 46.05, the next major resistance, which coincides almost perfectly with the daily MA20. That convergence of a horizontal resistance and a dynamic moving average creates a magnet and a battleground. On the support side, the first real floor is 4,541, which is yesterday's low and the bottom of the recent consolidation. Below that, 45.15 is the liquidation wick low from last week. If we lose 45.15, the monthly structure doesn't break, but the weekly sell pressure would accelerate toward the 200-day at 43.78. So the technical hierarchy is clear. Above 4,586, the bulls grab control for a run to 4,605 and possibly 46.74. Below 45.41, the forced liquidation was not a trap, it was a warning, and we head back to test 45.15. This compression between 45.41 and 45.86 is a coiled spring. Now let's talk about the fundamental driver and the cross-asset link that nobody is connecting. The headline says gold prices climb as US-Iran peace hopes weigh on oil and the dollar. That's only half the story. Yes, a potential de-escalation in the Middle East crushes the geopolitical fear bid in crude oil. WTI is down, and oil's risk premium is evaporating. Typically, that would also remove a geopolitical bid from gold, but gold is rising. Why? Because the other side of the equation is the dollar. Peace hopes push the dollar lower as safe haven flows reverse, and a weaker dollar lifts gold. More importantly, this forced liquidation in gold was not about geopolitics. It was a liquidity event. Overleveraged long positions in gold were systematically blown out when margin calls spilled over from the equity and bond market gyrations. The article asks, will gold's forced liquidation quietly become the setup for the next great bull run? I believe the answer is already being written. When you see a rapid flush that does not break the monthly trend, and then price recovers while real yields are topping out, you're looking at a bear trap. The fear architect, gold, is now sniffing out a potential peak in real yields. As US rate expectations start to price in a pause or even a cut later in the year, the opportunity cost of holding gold diminishes. The cross-check with oil is fascinating. With oil down sharply, headline inflation may cool, which gives central banks room to pause, which is ultimately bullish for gold. So the very reason gold sold off last week, fears of persistent inflation and higher rates, is being undercut by the oil collapse. This is the irony. My 1 to 2 week directional lean is cautiously bullish above 45.41. I expect a grind toward 46.05, and if the dollar breaks key support, a chase toward 46.74. The event that would invalidate this thesis is a sudden reversal in the dollar index, perhaps on hawkish Fed minutes, that pushes the DXY back above its own resistance. But right now, the dollar is heavy, real yields are stalling, and the forced liquidation cleaned out the weak hands. The structure is primed. Most people will skip this next part, but this is where money is made. Keep watching because I'm about to hand you 3 precise trade blueprints with exact levels, stops, and targets. This is your plan for the next 24 to 48 hours. Strategy 1. The sniper, conservative. We only enter on proof of breakout, not hope. The trigger condition is a 4H candle close above 4,586 with conviction, followed by a successful retest of the 4,586 level as support on the 60-minute chart. If that happens, you enter long at 45.88. Stop loss sits at 45.74, just below the 1 HMA20 and the breakout point, risking $14. Target 1 is 4,605, which gives a risk-reward of approximately 1 to 1.2. If we clear 46.05, target 2 opens at 46.25, the next structural resistance, achieving a 1 to 2.6 risk-reward. This setup is void if the breakout candle gets instantly rejected and closes back below 4,582. In that case, you stand aside and wait for a better base. The logic: you're buying a confirmed trend shift on the 4H, not guessing. Strategy 2, the active trader, standard. Here we fade the fear. You wait for a pullback into the support cluster between 45.45 and 45.41. Entry zone is 4,545, and you add only if the 1H RSI touches oversold territory without breaking the 4,541 floor. Stop loss is placed at 4,535, $10 below entry, right under the liquidity pool beneath support. That's tight. Target 1 is 4,575, just shy of the 4,586 wall, giving a 1 to 3 risk reward. Once target 1 is hit, move your stop to break even and let the rest run toward 45.86. If 45.86 breaks, the trailing stop moves to just below each subsequent hourly candle low. Target 2 becomes 46.05. This setup is a momentum capture inside the range, exploiting the hourly strong buy trend while respecting the daily resistance. The risk is a sudden dump, but the 45.41 line is your shield. Let's see how aligned we are. Type your XAU or USD range for tomorrow in the comments right now. I'm reading them. Do you think we break 45.86, or do we fade from there? Drop your high and low strategy 3, the aggressor, high risk. This is for traders who can stomach a fast reversal. The countertrend short on rejection of 45.86. Entry condition. Price spikes into the 45.84 to 45.86 zone on the 15-minute chart and forms a bearish engulfing or a shooting star with a long upper wick. You enter at 45.83. Stop loss is extremely tight at 45.91, risking $8. The logic: a false breakout trap where momentum chasers get caught and liquidated. Target 1 is 4,563, just above the 1 HMA10, a quick scalp. Target 2 is 45.50, the MA5, and intraday support, capturing a $33 move for a 1-to-4 risk reward if it plays perfectly. Only for those who know how to lose small and manage risk aggressively. If the 15-minute candle closes above 45.88, the setup is dead and you get out instantly. This is a dangerous play against the hourly trend, so size accordingly. Point 1 sentence on risk. Never risk more than 1 to 2% per trade, no positions through high-impact news like FedSpeak or CPI, and stops are non-negotiable. Here is the summary. The one most critical level for the next session is 4,586. A 4H close above that opens the door to 46.05 and the daily MA20, potentially igniting the bull run the forced liquidation setup. Below 45.41, the trap is sprung on the bulls and we revisit 45.15. Tomorrow's focus is the US session PMI data and any further dollar flows. If the dollar index breaks its overnight lows, gold could explode. I'll be back with the full breakdown on Bitcoin and the S&P divergence, showing you how the risk asset shadow is mispricing the bond market. That video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell so you never miss a daily institutional breakdown. I'll see you in the next one.